Despite numerous economic and market challenges, among others, the surplus lines insurers market share has more than doubled over the last 20 years, from 4.3% of total property casualty direct premiums written in 2001 to 10.1% at the end of 2021. Here to explain some of the dynamics leading to that growth are Director Robert Raber and Associate Director David Blades. And David, starting with you, on top of that overall market growth, surplus lines writers more than doubled their total share of commercial market premiums. What's fueling this pace of growth?
Well, John, there are a few different things that are fueling the pace of growth. I think historically, during times when economic conditions place stress on admitted market companies, they've generally kind of re-examined their risk appetite and in some cases pull back from the medium to higher hazard risk that they may have been writing in the marketplace, kind of taking a look within. And that has led to more of that business going through the wholesale market, which then offers opportunities to surplus lines underwriters. Also, and this is kind of part and parcel with what we've been seeing, there are certain classes of business, certain lines of coverage that have been, more under stress because of performance issues. You look at general liability and those kinds of lines that have been stressed by social inflation and things of that nature. Catastrophe exposed property. We've been seeing more in the way of, secondary perils and wildfires that have been impacting the property market. So some of those types of risks have been, again, coming through the wholesale market, and they've offered opportunities for surplus lines writers to propose insurance solutions for those types of risks that, again, are presenting higher hazards. We've heard from more and more of our rated insurers that, they have an elevated submission flow. They're getting more and more bites at the apple, so to speak. And so through those additional opportunities, you've seen opportunities for them to write more business. They're finding more accounts that fit their underwriting criteria. And again, using the freedom of rate and form that is endemic to surplus lines insurers, they're getting a chance to write that business. And, I think all those factors, in addition to just, like I said, harder market conditions that have push premiums up for, again, the different tough coverages of tough class of business like cyber liability, like professional liability and some general liability classes, and again, catastrophe exposed property, that's giving surplus lines insurers a chance to grow, and that's propelled a lot of the growth.
Are there certain lines of business that are proving to be more attractive to surplus lines writers?
Well, I definitely think because of the nature of the risk, I mentioned cyber just now, again, because of the dynamic nature of the risk and all that's entailed there, I think the solutions right now that are coming from the marketplace, more and more of that is being focused on the surplus lines market because, again, the freedom of rate and form, the ability to craft coverage that can really address the specific issues that are pertinent to a particular insured. I think that's one of the lines that's helping drive the growth, and that's really been helping to fuel the surplus lines growth. Environmental liability, and more, again, as we deal with more ESG type concerns, environmental, social, and governance concerns, environmental liability risks, again, those are more moderate to higher hazard risks. Those are some risks where we're seeing more opportunities for surplus lines writers. The energy field, like I mentioned, catastrophe exposed property. And like I said, general liability, those types of risks where we've been seeing social inflation have an impact of more of those nuclear type of verdicts that are coming out. And so that's impacting a lot of the different risk classes from a general liability standpoint. And some of those opportunities come through the surplus lines market as well.
What are we seeing in terms of M&A when it comes to the sector, and what impact is that having on distribution?
Well, I think there's definitely, when we look back at the numbers from 2020 and 2021, and possibly even before that, in terms of M&A activity with regards to wholesale brokerages and MGAs, managing general agents in the marketplace, specifically those that are focused on surplus lines, it's been a lot of activity in that regard. There's a lot of M&A activity. There's a lot of, whether it's private equity or just capital that's out there that's interested in that market space. And so there's been a lot of activity with regards to that. And that's definitely increased the number of MGAs and brokerages out there that are focused on surplus lines. So we've definitely seen that have a material impact. From a company perspective, we're still seeing, there's been less M&A than on the distribution side, but it's still part of the marketplace, and there still have been some impactful deals over the last few years. But definitely from a volume perspective, the distribution marketplace is definitely, seeing a lot of that. And again, it's changed that marketplace a great deal. And I think we're going to continue to see interest, and like I said, even from private equity in that marketplace. And that's something that we see we'll continue to look at going forward.
Robert, what are some of the opportunities for surplus lines writers in the current market environment?
Yeah, there's plenty of opportunities in the market. David mentioned already cyber. That's definitely a risk that's evolving that really plays into surplus lines carriers' specializations of updating their forms and their policies to meet the needs. We also think that cannabis is definitely a field that's going to continue to see growth for surplus lines writers. Many admitted companies are not interested in writing cannabis. They view it as outside their risk tolerance or what they want in their risk profile. But more and more states are legalizing that market, and states that legalized that market a few years back, they're getting the businesses there are getting a lot of scale, and they have insurance requirements. They have to have property damage coverage. They have to have product coverage. They have to have general liability for their facilities, for their storefronts. So we think there's going to continue to be growth in those specific areas. We also see some specific lines such as excess property, professional liability, excess liability also continue to have some ramp and some runway for the surplus lines carriers. But I think one of the biggest opportunities is for established commercial lines companies to start a surplus lines subsidiary or affiliate so they can meet the needs of their commercial lines insureds and keep them within the organization, so to speak. And we've also seen some new capital and some new startups coming to the surplus lines market. For AM Best, one of the things we view, one of the facets we're going to look at is the underwriting performance for those new startup surplus lines companies. Surplus lines opportunities can lead to misfortune very quickly. If you don't have the right underwriting acumen and the underwriting staff to really monitor those unique, bespoke kind of risks that you have. So it's going to be interesting going forward to see how that capacity plays out. But there's definitely opportunities for, I think, a couple more players as we've seen come online, and they all seem to have enough run room to build up their book of business to get a nice established profile.
Can you talk to us about the role of fronting companies and how they differ from core surplus lines writers?
Yeah, that's an interesting dynamic. Just for a little framework, when we're talking about core surplus lines writers, those are the companies that they're established, in the market. They have their market positions. They are truly looking at what is the traditional surplus lines risk, new, unique, bespoke coverages. Sometimes that's outside the desire of an admitted market company. Really the answer to the question from an insurance professional's view is that I have a new risk. Where do I place it? What company can take it? And you might think of Scottsdale, Lexington, Lloyd's, James River, Kinsale, that whole basket of organizations. About 6 or 7 years ago, AM Best started noticing more startup companies using the approved surplus lines structure, but coming into the market as fronting organizations, companies that work between delegated underwriting authority enterprises, almost entirely MGAs, but those kind of organizations, and reinsurance partners to make a bridge for coverage for very specific program business. And many times that business is auto, commercial auto, homeowners, or surety kinds of business, the kind of exposures that you don't traditionally see in that core surplus lines market. So, when you think about the difference, the examples I give is, on any state's export list, you'll probably find amusement parks. That's the kind of risk that's going to go right to a traditional surplus lines company. But, as I noted, those fronting carriers might be writing non-standard auto, and that's not something you usually see as the bulk of the prime line for a surplus lines company. This is something we've actually seen in the past. State National has been a big participant in the fronting line for many years. They're part of Markel. That's one of our top 5 surplus lines companies in our ranking. James River has a subsidiary that also does fronting business. So we've kind of seen this blending in the past. But this year, especially when we were putting together the data for this year's report, we saw companies like Clear Blue and Trisure coming into the top 50 surplus lines companies. So we saw a little bit of a displacement in that ranking. And we've seen some indications that there might be some more displacement in the next coming years, some industry observers say there could be $100 billion worth of premium going through fronting companies. And there's a couple of fronting companies just under that top 50 list. I think the big thing, the overall thing, is that all of this points to the capability and the credibility of being an approved surplus lines company, being able to create that bespoke coverage, whether it's for a very specific risk or for a very specific program. And if you have that underwriting talent within your organization, they can really make that work well to everyone's benefit.
Thanks, Robert. David.
Thank you, John.
Thank you.
You can find the full surplus lines report at ambest.com. For AM Best TV, I'm John Weber.